What's up everyone, it's Caddy with MoneyVest. So in this video, wanted to discuss one stock that I believe is going over a significant sell-off right now. It's been selling off for quite some time, and it does represent pretty significant opportunity. And I'm gonna go over another one, and not really specifically from a share perspective, but we are gonna talk about two option trades, and I'm gonna explain how that works. So it's gonna be super educational and also very valuable information for you that you can take and of course apply in your own trading style. And it's also going to limit your downside. So, we're going to talk about an option strategy called leaps. And these are longer dated options that you basically purchase deep in the money, and that allows you to control 100 shares of any specific stock, right? It's not really, you're not shelling out, the money to buy 100 shares of a stock, but instead you are basically buying a leap contract, which is a type of options contract, to control 100 shares of a specific company. And this particular stock actually makes a lot of sense, except for a few loose ends that I want to touch on in this video. So hope you guys enjoy it, find it helpful. Make sure that you drop a like. Don't forget to subscribe to the channel. And of course, link to our Discord and Patreon is going to be down below. In fact, the calculator that I'm going to be using, the Excel spreadsheet that I'm going to be going over, is available for you to download. So these right here are all of our Excel spreadsheets that you can download from Patreon straight. And this is the downloadable Leap calculator Excel file that I'm going over in this video that I think is going to be super helpful for you to better understand and use this in conjunction with the members only private videos. So this right here is members only private videos. We got over 42 of those right now, and it's being updated every single day. So you'll notice updated October 4th. So I'm constantly updating it with new information. But if you come down, you'll notice that we've got an options strategy right here. So option strategy number 3, introducing leaps. So watch this video and use it in conjunction with this calculator to better understand what we are going over in this. So first stock is going to be InMode, INMD, and I believe that this stock right here, the fact that it's been selling off so aggressively from its highs of $48, down 44%, I've already done a video on this company, so definitely do check that out. And what we're trying to figure out in our community right now is how big is this market, right? How big is the market for this type of equipment that InMode sells to surgeons and physicians all over the world. And we know and we understand the management is extremely transparent. This is a company based out of Israel, so that does turn some people off. But if you take a look at the fundamentals and the revenues and cash flows, everything has been phenomenal. Like, it's been absolutely fantastic. Take a look at that growth, coming in since 2017 all the way through 2022. Every single year, they've been consistently growing revenues, earnings, profits. When you come over to the shares outstanding, so this right here is going to be that diluted share count that also has been pretty stable. So this right here is the share count. It's gone from 65 million to 85 million in the last 6 years or something, right? So it's not really, they've not really issued a lot of shares. And I remember my fair value being close to around low 20s, even closer to $25, $26. I think in a more recent video that I did was closer to those prices. And earnings expectations, so the future forecast is also pretty strong, from 267 all the way to over $4 a share. And revenue is also expected to go from all the way to 450 million to over $700 million for the company. And the beautiful thing about this is that, take a look at their balance sheet, right? If you come over to statements and balance sheet, they're sitting on a net debt of negative $625 million, meaning they've got a ton more cash. So in other words, total current assets, cash is sitting at $629 million versus their total liabilities is $68 million. So they've got a fantastic balance sheet with more cash than all liabilities combined. So bankruptcy risk is near zero. And that's exactly why I want to introduce a potential trade idea with leaps. Now, leaps are long dated options, right? So there are a lot of pros and there are some cons with buying leaps as well, because with leaps, we're not going out 1 week, 1 month, or 1 year. We're going out to as much as possible, right? So in this case, since the options chain allows us to go as far as 2026, if you drop this down, we're looking at 834 days. Now, the only problem with this is that there is no open interest, right? There's not a lot of volume with InMode specifically. So maybe I should have looked at that before doing the video, but there's not a lot of volume here. Actually, I'm looking at a different stock. I'm so stupid. This is Vertex. This is Vertex. Let's take a look at in mode here. Let's see if there's any. Okay. So for January 2026, okay, there's some volume, but again, there's not a lot of volume for the $15 strike $16 premium at the moment. There's not a lot of volume or open interest for this particular contract. So that's something that we may need to wait for the price to maybe come down a little bit further. I mean, the lower it gets, the better, and the more likelihood it's going to be that there's a potential opportunity for it to come down to $15. That's exactly why you could start to see some people write contracts, for those calls. But let me kind of show you the dynamics and how it actually works and how you can limit your downside by going after leaps as opposed to buying shares. And I'm going to go over the second stock as well. So this right here is the calculator, and I've already plugged in the values. So what we have done is put in the today's date, October 5th, the ticker symbol, the quantity, which is going to be 1 because one contract is 100 shares, the action, the type, which is going to be leap. So most of the times you guys know that I sell covered calls, sell cash secured puts. But in this example, in this sort of educational tutorial, we're going over leaps. The price, which is the today's price. So right now in mode is trading at $28.20, roughly around those prices. And the strike, right? So right now we're looking at a contract which is a strike of $15, and the premium, right? Since we are going to be the buyer, there's a pretty wide spread between $16 and $19. We can go with somewhat in the middle, so I'm going to go ahead and put $17 because if you take a look at the last traded price, actually for this one is $13.60. Which is actually a little bit higher than the asking price. This right here is $10.20. This right here is going to be $9.10. So it's all over the place. So we're going to go with $17. I'm going to put in the premium over there at $17. And what you'll notice is the expiration, again, 2026, the premium right here, the cost is $60, right? What does that mean? That simply means that if I were to buy a leap on InMode at $15 strike and pay $17 for that option, that $17 is 60% of the current market price for InMode, right? So in other words, if I wanted to buy 100 shares of InMode today, I would be putting up $2,800, right? That's how much the market price is. So $28 times 100 shares, that's $2,800. But if I want to buy a leap instead, I would only be paying $1,700 and not $2,800 because that's the cost reduction of buying leap. So that's a huge benefit, right? That's benefit number one. And preferred number is under 60%. So the debit obviously comes up to $1,700 because one contract is 100 shares. The premium is $17. So that's a debit of $1,700. Now there is going to be intrinsic value and extrinsic value. And again, a lot of this is broken down into my other video where I go over this right here. So option strategy, this is a 30-minute tutorial which goes over everything you need to know about leaps. But the only thing you have to understand is that the premium makes up both the intrinsic value and the extrinsic value. And right now, 22% of the premium is made up of extrinsic value. We want this number to be as low as possible, preferably under 5 to 10%. And the extrinsic value yield is a little bit under 34%. So that's actually pretty high. And we want this number to be also under 5%. So these are the only two loose ends right now from InMode. And what this basically means is that the amount of extrinsic value that you're paying, in order to make back that extrinsic value, you need to yield 34% on the 40% that you did not spend by buying a leap versus shares. I know it's a little bit complicated. I trust me, if you watch this tutorial, it's going to clear everything up. But the only thing you have to understand is that this is potential. I mean, it's got some level of attractiveness to it. I'm thinking about buying a leap on InMode, but only, of course, if the prices do pull back a little bit further and we have some more open interest and some more volumes on these leap contracts on InMode. Because InMode obviously is a not that popular stock, right? It's just not a company that you'd see a lot of people trade or invest in, even though it's over $1 billion market cap, very, very profitable, very strong, moat in the market that it trades in. But even then, there's not a lot of open interest or volume. Now, break even's at $32, and right now it's at $28. So it only needs to go up over $4 in order for this option contract to be break even. And that's about a 14.5% upside. And the delta is going to be 0.928. So we want this delta to be as close to 1 as possible. So there's a lot of things that I like here. These are the couple things that obviously are going to be difficult. 33, 34%, that's very, very high. But even from a regular share perspective, I think it's coming down to some very attractive levels and some very good fair value levels because, like I said, excellent balance sheet, little to no dilution, checks off all the boxes, consistent growth in revenue, earnings, profitability. Everything is fantastic, and valuation is also down to now 13 times earnings, a little under 5 times sales, price to cash flow at 14, and we're looking at very, very strong return on invested capital, return on equity, and return on assets, right? Over 29 to 30%. So this is, this is a definition of a fantastic stock, right? Fantastic company and a well-run company. So that's something to keep in mind. Of course, $26, $27, very nice support. And if it ends up in the low 20s, there's a couple things that I could do. I could either sell puts, or I could buy leaps, or I could buy shares. Either one of those three things, in my opinion, I will probably end up doing if it ends up in the low 20s in the future, right? So if it ends up below 25, $24, I will most likely be doing one of those three things that I mentioned. Now, the second stock that I think is very important for us to look into further, and we have obviously been dollar cost averaging, I've personally been buying that stock as well, is going to be Enphase, right? So ENPH. Now, this is also trading at a very nice support. So I want to run through the same analysis for leaps for Enphase. And look, this is what I found. And let me just quickly check the open interest and the volume for Enphase, because I didn't really pay attention to that last time. Let's see here. And we've got some volume, folks. We've got some open interest. So there is, actual people trading, even though it's not heavily traded, like only 2 contracts or 12 contracts or 3 contracts. But eventually, if of course Enphase does break down, if it continues to trade and the time goes on, there's going to be more and more contracts being written with those strikes, with those expirations, because you're going out 834 days, right? So that's a pretty long time. Now, same concept with Enphase, right? So you're looking at one by leap, $117 is the price. The strike, $60. That's the lowest it's getting down to. And then the expiration is going to be in 2026. The premium, you'll notice, is $71.10. Although the last traded price was $70, right? So we can actually come even lower at $70 because that was the last traded price. The cost, again, is 60%. So that's exactly what we want. I mean, the lower the better, right? We want this to be 40, 50%, but anything under 60% is good. Debit, $7,000. The intrinsic value is $57. So what that basically tells us is that off the premium of $70, $57 makes up the intrinsic value. And I'm not going to touch on too much here because this is not supposed to be like a detailed tutorial. For that, you've got the private video, but extrinsic value is $12.82. So it's a little bit over 18%. Of extrinsic value that makes up the premium. Extrinsic value yield of 27%. So in other words, you need to make a 27% return over the next 2 years in order to justify paying that extrinsic value of $12.82, which is going to be a little bit more tricky. What does that come down to? Like about 12.5% per year. Not the most impossible thing to do, but it's certainly something to account for when you are looking at leaps. And of course, the break even about $130, which right now is, again, it's trading at 117. So it would only need to go up a little bit over 12%, right? Which from a recovery standpoint, from a reversal standpoint, it's a very, very solid. And we're looking at a very, very good delta. And of course, day sale expiration. Now, 2 things I did not touch on that I want to talk about in this video. Number 1, upside, unlimited. If Enphase goes up to 300, 500, 800 in the next 2 years, does not matter. Maximum upside is unlimited, right? We can literally just go to the moon and the leaps are going to obviously profit. Number 2, downside, limited, right? So it's not unlimited, it's limited because whatever. So for example, if I end up buying a leap for InMode or Enphase, the maximum I can lose is the premium that I paid. And in Enphase's case, it's $7,000. In InMode's case, it's going to be $1,700, right? So that's the maximum premium I am risking in order to buy this leap. Because if the price trades below my strike, right? So in the Enphase's case, let's say that I go with $60 strike. If price trades below $60, that call is no longer in the money. It's out of the money so that I can't exercise it. I don't have to buy it. I don't have to sell it. I can simply just, let that option contract expire worthless and out of the money. And well, guess what? I will end up losing that $7,000. But instead, if I buy the shares, then the max loss is my entire investment, which is going to be entire $11,700 because I'm pretty much investing, to buy 100 shares. But with leaps, you're investing less, so your downside is less, even though you're capturing almost all the upside. So that's what we have covered in our previous videos. But I do believe that Enphase and InMode, they both make up for a good potential leap trade. The only couple loose ends are the extrinsic value yield, which, we've talked about, and that's something that we will discuss as it develops. If the price continues to fall, then that extrinsic value yield is also going to come down. It's going to come down to that sweet price of about under 5%. Maybe not 5%, but potentially under 10% is what I would be looking for. But, that's what we're looking for in those 2 companies. And again, if you want to get access to all those alerts and find out exactly what we're doing, get access to all the spreadsheets, private videos, members only videos, alerts, all those things. Links going to be down below. We'd love to have you on board. And as always, happy investing. I'll see you all in the next video.